So now we look at what is depreciation. Okay, usually we have an idea about what is depreciation, but IFRS gives a different angle to depreciation. So we'll see like what is depreciation, the methods that are used in depreciation, their advantage and their disadvantage. Okay, all of that are what we are going to see. So we'll start. So depreciation is the systematic allocation of depreciable amount of an asset over its useful life. So what we do is we take an asset value and we divide it into over its useful life, and we are trying to put it in the P&L account. Okay, so we would have bought an asset for 1 lakh, and the life of that asset would have been like 10 years. So it means every year the asset gets depreciated by 10,000. So every year we put 10,000 in the P&L expense. Depreciation spreads the cost of the asset over the period in which it will be used. So that is the 10 years. Depreciation matches the cost of using a non-current asset to the revenues generated by that asset over its useful life. Okay. So normally what we think is depreciation is something like a reserve. So every year we are going to save like we are going to deduct 10,000 from the P&L or profit. Okay, so we save that 10,000 rupees and finally we'll buy a new machine. Okay, so it's not like that. Actually, it works like this. The machine is used to produce the good. Okay, and the good is sold. Okay, so when the good is sold, that machine has been used to produce that good, right? So for example, if you use like 1 kg of some raw material, okay, uh, which is like 100 rupees, and you have sold a product using that raw material for 200 rupees, you are like making a profit of 100. Okay, that's fine. But you have used that raw material and you have put it into a machine, and that machine is what have converted that raw material into a finished good. Okay, so how can you like not consider the usage of that asset? Okay, so you have to take the usage of that asset also for the production of that item. Okay, so exactly you should know like how much you are like trying to you are able to make the profit. Okay, your profit should be like exact. Okay, so this is about the matching concept here. The product which has been sold has been produced through a machine, so that machine has been used, so the machine has to the machine cost also have to be like considered while finding out the profit. So the machine cost is a depreciation. Okay, so depreciation must also be matched to the pattern of the use of asset. According to IAS 16, the estimated life of items of property, plant, equipment must be regularly reviewed and may be changed if the method no longer matches the usage of asset. So what he says here is, see, if you have an asset, okay, if you have a like a machinery, and that machinery has not been used for around 6 months, so should you like produce, should you have a full year depreciation? The answer is no. Only when it is used, okay, and producing the goods, it should be like depreciated. Okay, so also the pattern of usage, for example, in this year you are like heavily using that asset, next year you are not going to use 50% of the asset, only you're going to use, means this time you can charge 2 times the depreciation and next time you can charge 50% of the depreciation. So even that is like available in IAS. This is achieved by recording a depreciation charge each year, the effect of which is twofold: reduce the statement of financial position value of non-current asset by the accumulated depreciation to reflect the wearing out. Okay, so the value of the machine keeps on falling out because of the usage, and also record the depreciation charge as an asset, as an expense in the SOPL to match to the revenue generated by the non-current asset. So depreciation is a expense that has been like used to produce the asset, so that has to be deducted from the P&L here. So that's about the conceptual idea of depreciation. So what and all can lead to depreciation? So use of the asset, physical wear and tear, passing of time like 10-year lease or something, obsolescence through technology. For example, some products become useless because of a particular change in technology, or depletion. Okay, we keep on extracting mineral from a quarry, So it gets reduced. The purpose of depreciation is not to show the asset at its current value in the statement of financial position, nor it is intended to provide a fund for the replacement of the asset. Okay, both these concepts are wrong. It is simply a method of allocating the cost of the asset over the period estimated to benefit from its use. So the actual thing is to charge the profit. Okay, make a charge on the profit. So land is normally has an unlimited life, so there is no depreciation which is required on that. But buildings on that land is depreciated. Depreciation of an asset begins when it is available for use. Okay, so only when an AC is bought, depreciation doesn't begin. Only when you put that AC, okay, put all the copper wire fittings and everything. When you switch on, the AC should work. Once it starts to work, from there on we can charge a depreciation. So here we look at the methods which are used in depreciation. Okay, so the first one is straight line method. So this is a formula. The depreciation per year would be cost minus residual value divided by useful life. What is residual value? The estimated disposal value of the asset at the end of its useful life. Okay, so it's like something like scrap value. Useful life is the estimated number of years during which the business will use the asset. Okay, so it's not that the asset might have 50 years of life. If we are going to use it only for 10 years, so we can put 10 years life here, and in 10 years time, what is the value of that scrap? Okay, that value you can put it here. Okay, so it's not that the 50-year value we have to put here. Up to how much we are going to use, that alone we have to charge. The straight line method results in the same charge every year and is used wherever the pattern of usage of an asset is consistent throughout its life. Okay, so the straight line method usually gives the same amount of depreciation every year. Okay, it's like 10,000, 10,000, 10,000. So it should be applied to an asset where the usage is like consistent. Okay, every year we are using like 10% of that asset, something like that. Only in that case we can use it. Buildings are commonly depreciated using this method because businesses will commonly get the same usage out of the building every year. Okay, so we are going to use it like consistently every year. The useful life does not necessarily equal the physical life of the asset. For example, many businesses use a 3-year useful life for computers. Okay, so computers are usually depreciated in 3 years. That does not mean after 3 years the computers are useless. The computers could still be used, but the depreciation, it would have been like zero value of asset. This does not mean that a computer can no longer be used after 3 years. It means that the business is likely to replace the computer after 3 years due to technological advancement. Okay, so it can change it or it can put it in some other department. For example, in IT companies, if the old computer is like it does not serve the purpose for software engineers, the old computers will be given to admin employees. Okay, administrative employees or security employees to them. Okay, so they will use it. So those department will use it, or any finance department. So those departments don't need to have high-end computers. Okay, so it will be given to them. So it's not that it is like thrown away from the company. Okay, so we'll see the merits of a straight line method. See, this is a very simple and easy to calculate method. The value of asset can be reduced to zero. Okay, so every year you provide 10,000 as depreciation for 10 years for a 1 lakh rupee worth of asset. The value of the asset will come to zero. This method is suitable for those assets whose working life can be easily estimated. So you can estimate it easily and it keeps on working in the same pattern. What's the demerit? The same amount of depreciation is charged every year irrespective of the use of the asset, because sometimes we might use it heavily and sometimes we might not use it heavily. So the utilization is not properly taken by this method. As the amount of depreciation remains fixed even during the inflation period, maintenance of capital becomes difficult. Okay, see, the depreciation is not inflated. It's like related only to the asset value. Okay, so every year it is always going to be 10,000. Because inflation is going to be 10% every year, it doesn't move from 10,000, 11,000, 12,000 like that. So that is actually a problem. Okay, that is actually a problem. Okay, because in 5 years time, the cost of raw material would have gone up. Okay, the selling price would have gone up, but depreciation alone would be 5-year-old depreciation. So that doesn't sound proper. Okay, because we wanted to find out the real cost, the real profit we wanted to find out. But depreciation, if it's not inflated, it's not giving the real ideal what to say real profit. It's not like giving us. So that is a problem. This method tends to report an increasing rate of return on investment in the asset on account of the fact that the net balance of the asset account is taken. So whenever you try to find out ROC, see, this is like out of context. Whenever we try to find out return on capital employed or return on asset, okay, the asset value, old assets will give more return on assets. Okay, it's only like what to say, two factories are there. One factory has new asset and the other factory has old assets. Okay, so one factory has new machinery and the other one has a old machinery. Both are having the same profit. Which company will give a higher return on assets? The old factory will give, because the assets are all depreciated. Okay, and the return on asset is like is good enough, so it will give like tremendous ROA it will give. But the new factory, okay, would be much more efficient, their cost could be lower, okay, everything would be better, but still they will report a lower ROA. Okay, so this is the problem with this kind of a method. Okay, so but still it's a very useful method, it's a simple method. Okay, quickly we can get an answer. So that's about this method. We'll move on to the next method, which is called as depreciation reducing balance method. So the depreciation charge is found out like this: depreciation percentage into carrying amount. So carrying amount is the asset cost of the asset minus accumulated depreciation. Okay, so we'll do the sum, we will get an idea. Carrying amount refers to original cost of the non-current asset less accumulated depreciation on that asset to date. The reducing balance method results in a constantly reducing depreciation charge throughout the life of the asset. This is used to reflect the expectation that the asset will be used less and less as it ages. This is a common method of depreciation for vehicles where it is expected that they will provide less service to the business as they age because of the increased need to service and repair them as mileage increases. Okay, so when this method, what it does is it charges a high depreciation at the beginning, and year as the year passes, the depreciation value falls down. Okay, the depreciation amount falls down. So what happens here is, initially there's high depreciation and later on it's lower depreciation, because initially we use it a lot, later on we don't use it a lot. So it is like applicable to vehicles and machineries. Okay, not all machineries, but certain machineries where the usage initially was so high, thereafter it becomes lower. So only when the machine usage or the vehicle usage reflects this kind of a pattern, you should use reducing balance method. So the good things about this method is elimination of a major portion of cost in earlier years. Okay, so in the beginning years itself, the depreciation is so huge. Fresh calculation of depreciation is not necessary as and when the additions are made. So you don't, the calculation is like quite easy here. Okay, why we will see later. The asset is never completely written off, so that some charges is made to revenue. Okay, so the asset never goes to zero. There is always some value still left. We look at the demerits. Under this method, the calculation of depreciation is complicated. As compared to the straight line method, it is difficult to determine the suitable rate of depreciation. The value of the asset cannot be brought to zero. So there will always, as long as the asset is there, it will always be there. It will always have a value and it has to be depreciated. This method lays too much emphasis on the historical cost. Okay, so that's about the concept here.